Two people, same age, same job, same salary, same apartment layout, same commute, same lunch from the same deli on the corner. At 28, their lives look identical. At 38, one of them has a number that arrives in their bank account every month without them doing anything that week to earn it. The other does not. The difference was not luck. It was not inheritance. It was not a viral product or a business that went public. It was $10 a day. Compounded, stacked, systematized. That is what this is about. $0 to $1,000 a year. This is the level almost nobody talks about because the number sounds embarrassing. $83 a month. $2.74 a day. It will not replace your income. It will not cover rent. It will not show up at a dinner party as something impressive. What it will do is prove something to you that no book can prove in your place. That money can be earned without trading your hours directly for it. The first asset does not need to be elegant. A digital template sold on a marketplace. A short ebook covering one narrow problem you have already solved. Dividend income from an index fund. A high-yield savings account treated with intention. The source matters less than the structure. You are building a proof of concept. You are showing your own financial system that a different relationship with money is possible. Most people skip this level. They hear about passive income and they picture the $30,000 month. They build nothing because the starting number feels insulting. That is the trap. The people who reach $100,000 a year in passive income did not skip this level. They stayed in it long enough to understand it, and then they moved. By the time you exit this level, you should have one asset generating income you did not directly earn that week. One. That is the entire goal. Write it down when it happens. $1,000 to $10,000 a year. This is where the mindset shift becomes structural. You are no longer asking whether passive income is real. You're asking how to make more of it without proportionally adding more of yourself. The pattern here is stacking. You do not abandon the first asset. You add a second one adjacent to it. A content creator with one monetized video builds 10 more in the same format. Someone selling one template builds a bundle. A dividend investor adds to the position systematically. The mechanism is not novelty. It is repetition with reinvestment. The number that matters at this level is not the income itself. It is the percentage you put back in. Every dollar of passive income reinvested at this stage has a disproportionate effect on where you land at age 38, 42, 48. You will not feel this compounding. It does not announce itself. It appears later, suddenly, like interest on a savings account you forgot to check. At $10,000 a year, you are earning $833 a month passively. That is a car payment, a portion of rent, a real number. You did not work a specific Tuesday to receive it. That is a shift. It is quiet and it is real. $10,000 to $30,000 a year. At this level, fragility becomes the problem. One income stream at $10,000 a year is a single point of failure. A platform changes its algorithm. A product stops converting. A dividend gets cut. The income disappears and you're back at the first level trying to remember how you got here. Diversification at this stage is not about hedging for intellectual satisfaction. It is about protecting the system you built. You begin separating your passive income into categories. Earned without direct time, meaning royalties, licensing, content revenue. Earned on capital, meaning dividends, interest, distributions. And earned through systems you built and then largely stepped back from, meaning digital products, affiliate structures, automated services. You want at least two categories operating simultaneously. $30,000 a year is $2,500 a month. At this level, you are covering a meaningful portion of your fixed expenses with income that does not require Monday morning. You do not quit your job at this level. You stabilize. You document what is working. You identify which streams require the least maintenance for their output. You allocate more time and capital toward those and less toward the ones that demand constant attention to stay alive. $30,000 to $60,000 a year. Your time is becoming the scarcest resource in the operation. You have systems that work. The problem is that they still have you in them more than they should. Something breaks and you fix it. A platform requires an update and you do it. A customer emails and you respond. None of it is hard. All of it is cumulative. This is the level where documentation and delegation change the trajectory. You write down every repeatable task in the system. Everyone. How a product gets updated. How customer inquiries get handled. How content gets distributed. How reports get reviewed. You are not writing a business manual for its own sake. You are identifying which parts of this operation require your judgment and which parts require only your process. The parts that require only your process get outsourced or automated. A contractor, a tool, a service. You pay for this out of the passive income itself. This is the correct use of the money at this level, not lifestyle expansion, infrastructure. At $60,000 a year, you're earning $5,000 a month from assets and systems. You're not fully removed from them. Anyone who tells you passive income at this level requires 0 hours a month is describing an outcome they have not personally verified. But you are spending real hours on things that are not your job. That is a different life than the one you had at zero. $60,000 to $100,000 a year. This is the level that changes the math on everything else. $100,000 a year passively is $8,333 a month arriving without a shift, without a deliverable, without a manager named Carla or a meeting that could have been an email. For most people in most cities, this covers life, not extravagantly, solidly. The transition from $60,000 to $100,000 is less about adding new income streams and more about protecting the ones you have. You build a cash reserve specifically for passive income volatility. 3 to 6 months of average passive income held in liquid savings, separate from your emergency fund. When a platform demonetizes a channel or a market corrects and dividends fall, you do not panic sell and you do not restructure the system in the wrong direction. You draw from the buffer and let the system recover. You also meet with a tax professional at this level, not as an afterthought. As a scheduled event, passive income is taxed differently depending on its source. Dividends, rental income, royalties, capital gains, each has its own treatment. The difference between an optimized and unoptimized tax position at $100,000 of passive income can be $8,000 to $14,000 annually. That number is real. It compounds in the wrong direction if you ignore it. Here's what passive income actually means at $100,000 a year. It means maintenance. It means monitoring. It means occasional rebuilding when a platform dies or a product becomes obsolete or a market shifts. It is not a beach. It is a system you designed well enough that it runs most of the time without you and requires you periodically, but not constantly. The two identical people at 28. One of them built the first asset. The other waited for a better time. By 38, the gap is not $10 a day. It is a life that looks structurally different in a way that no single paycheck can close. $100,000 to $250,000 a year. At $100,000 a year, you prove the system works. At $250,000 a year, you prove it can defend itself. The difference is a moat, not a metaphor. An actual structural advantage that makes your income harder to replicate, harder to displace, and harder to eliminate when conditions change. Audience trust is a moat. A newsletter with 80,000 readers who open it because they trust the voice behind it is not easily replaced by a cheaper version. Proprietary data is a moat. A platform or tool that improves as more people use it has compounding defensibility built into the architecture. Distribution is a moat. If you own the channel through which attention moves, you are not dependent on someone else's algorithm to survive. At this level, you are not just building income streams. You are building something that would take a competitor meaningful time and capital to recreate. If a new entrant could copy your entire operation in a weekend, you do not have a moat. You have a position that works until someone with more resources decides to take it. The income at $250,000 a year is $20,833 a month. It arrives from multiple sources. The sources are not identical. They do not all move together. When one contracts, the others do not necessarily follow. That is the design. You did not arrive here by adding more of the same thing. You arrived by building adjacent streams that share your core asset, your audience, your data, your distribution, but generate revenue through different mechanisms. $250,000 to $500,000 a year. You cannot work your way to this level. The hours are not there. The only path from $250,000 to $500,000 in passive income is multiplication, not addition, not more effort. More channels carrying the same system. The operator at this level has standardized everything that can be standardized. There is a document somewhere that describes how every repeatable function in the operation runs without requiring a specific person's presence to execute it. The content calendar runs. The fulfillment system runs. The customer experience runs. They run because the process is clear enough that the person executing it does not need to invent anything. They follow a system that was designed once and then tested until it held. Hiring at this level is not about finding people to do what you do not want to do. It is about finding people who are better than you at specific functions and then removing yourself from those functions entirely. A director of operations who manages the systems so you manage only the strategy. A finance person who runs the numbers so you review the summary. The goal is not delegation as a task. It is structural removal of yourself from the parts of the operation that do not require your specific judgment. Your income at $500,000 a year is $41,666 a month. Most of it arrives while you're doing something else. Some of it arrives while you're asleep. The system is running. You review it. You adjust it when it signals a problem. You are not in it the way you were at $30,000 a year. The relationship has changed. $500,000 to $750,000 a year. This is where fragility hides in success. The operation is large enough that a single bad decision, a concentrated bet, a leveraged position that moves the wrong direction, an over-reliance on one platform or one partnership can erase years of compounding in a quarter. You have seen people at this level. They were at $600,000 a year and then they were back at $180,000 rebuilding because one structural risk they chose not to address finally arrived. True diversification at this level is not spreading across 10 content channels or 5 affiliate programs. It is spreading across asset classes that do not share the same failure conditions. Market-based income, real asset income, business cash flow, licensing and royalty income. If one category faces a regulatory shift or a macroeconomic correction, the others continue. You are not just diversified within a category. You are diversified across the conditions that would cause a category to fail. Conservative leverage means exactly that. Not no leverage, conservative leverage. Debt used to acquire income-producing assets with coverage ratios that hold under the stress scenario, not just the base case. You run the stress scenario first. You model what happens if the asset underperforms by 25%. If the debt still services without touching your operating reserves, the leverage is conservative. If it does not, it is not conservative regardless of what the base case says. You also build a contingency plan that is written down, not a general intention to be careful. A specific document that describes what happens if your largest income stream drops 40% tomorrow. Which expenses get cut first? Which reserves get activated? Which assets are liquid enough to sell without catastrophic loss? The contingency plan is not pessimism. It is the reason you are still operating when someone else at this level is not. $750,000 to $1 million a year. At $1 million a year in passive income, you are not running a side operation or a lifestyle business. You are running a portfolio company, and portfolio companies require governance. Governance means a board of advisors, or at minimum, a small group of people with relevant expertise who review your operation quarterly and are permitted to tell you when you are wrong. It means a compliance review that confirms your tax structure, your entity structure, and your contracts are current and defensible. It means financial statements prepared by someone other than yourself, reviewed on a regular schedule, used to make capital allocation decisions rather than filed and forgotten. The day-to-day at this level does not look like passive income in the conventional image. You are not on a beach watching numbers arrive. You are reviewing a capital allocation decision. You are in a conversation with a deal flow contact about an acquisition. You are approving a hire that changes the trajectory of one arm of the operation. You are reading a report that your finance person prepared and asking 3 questions about it. You are doing strategy. You are doing oversight. The assets are working. You are managing the assets. Capital allocation is the most important skill at this level. Every dollar the operation generates has a decision attached to it. Reinvest in the existing system. Deploy into a new asset class. Hold in liquid reserves. Return to yourself as a distribution. The wrong answer, repeated quarterly, degrades the portfolio over years in ways that do not announce themselves until the number is significantly smaller than it should be. Lifestyle inflation is the quiet killer, not the dramatic purchase, the gradual structural expansion of fixed costs that requires the income to stay high to sustain itself. The moment your lifestyle requires $750,000 a year to maintain, you have lost the optionality that the income was supposed to create. The income is now working to fund the life rather than build the asset base further. Here is the only takeaway that matters across every level from $100,000 to $1 million. The asset came first. The income followed. The system protected both. Pick one starting asset today. Set a 30-day goal for it that is specific enough to be measurable and small enough to be real. Build it, then subscribe, because the next roadmap covers exactly what to build next and in what order.